If you have spent any time researching how to invest your money as you approach or navigate retirement, you have almost certainly come across the debate between mutual funds and exchange-traded funds, or ETFs. Financial advisors, articles, and online investing videos constantly talk about ETFs like they are the undisputed champions of modern investing, while writing OFF mutual funds as old-fashioned. When you are deciding how to structure your retirement portfolio to protect your hard-earned life savings and generate reliable income for the next 20 or 30 years, this comparison can cause a great deal of anxiety. Let us start by breaking down the fundamental differences between these two investment structures so that you can see exactly how they impact your retirement security. At a high level, both mutual funds and ETFs are pooled investments. They take money from thousands of investors and spread it across hundreds or even thousands of individual stocks, bonds, or other assets. This gives you instant diversification, which means you do not have all your eggs in one basket, an essential principle for anyone approaching or enjoying retirement. They are priced once a day after the stock market closes. No matter what time of day you place an order to buy or sell a mutual fund, everyone gets the exact same price, which is known as the net asset value at the end of the trading day. Now, if you were investing in a standard taxable account, this distinction might come with another huge consideration: tax efficiency. Outside of retirement accounts, ETFs have a unique structural advantage known as the in-kind creation and redemption mechanism. Without getting too deep into the technical weeds, this process allows ETF managers to shield investors from unwanted capital gains taxes. In contrast, when an active mutual fund manager sells underlying stocks inside a mutual fund at a profit to meet redemption requests, taxable shareholders can get stuck with a capital gains tax bill at the end of the year, even if they did not sell a single share of the fund themselves. This reality frequently leads retirees to fear that leaving their money in mutual funds is a huge tax mistake. But here is the most important thing you need to know about your 401k. Inside a 401k, or any traditional or Roth IRA, tax efficiency does not matter in this way. Your 401k is a tax-sheltered account. That means all capital gains, dividends, and interest generated inside the account grow tax-deferred or tax-free in the case of a Roth 401k. You will never pay a capital gains tax distribution on a mutual fund held inside a 401k plan. The entire tax advantage that makes ETFs so popular in regular brokerage accounts is completely neutralized inside your retirement plan. That brings us to the next major question: is the ability to trade throughout the day with an ETF actually an advantage for a retiree? For almost all retirement investors, the answer is no. Real-time trading sounds exciting, but retirement planning is built on long-term strategy, not day trading. Indeed, intraday liquidity can sometimes be a trap, tempting retirees to make panic decisions during volatile market downturns. Mutual funds force a disciplined, once-a-day execution model that tends to keep investors focused on long-term horizons rather than moment-to-moment market noise. So why do so many people still believe ETFs are always better in a 401k? It often comes down to expense ratios and fees. Historically, ETFs gained rave reviews because they were dedicated passive index funds with dirt cheap fees, while mutual funds were dedicated actively managed funds charging high expense ratios to pay a manager to pick stocks. Over a 20 to 30-year retirement horizon, even a 1% difference in investment fees can eat away tens of thousands of dollars from your savings. However, the financial landscape has evolved dramatically. Today, most 401k plans offer access to low-cost index mutual funds, such as an S&P 500 index fund or a total bond market index fund, offered by providers like Vanguard, Fidelity, or Schwab. These institutional-grade index mutual funds often have expense ratios that match or are even lower than comparable ETFs. When comparing mutual funds and ETFs in your specific 401k menu, what matters is not the vehicle type, but rather the specific expense ratio of the individual fund and whether it is passively indexed or actively managed. This is remarkably common. The 401k industry was built from the ground up around mutual funds decades ago. For plan sponsors and administrators, mutual funds are simple to price, traded in single daily batches, and tie in easy-to-use asset allocation options like target date funds. While more modern 401k plans now offer brokerage windows that allow you to buy ETFs, many standard employer plans still stick primary to mutual funds. And that is completely fine. You do not need to worry if your 401k does not offer ETFs. Here is your actionable takeaway for managing your 401k funds effectively as you approach retirement. First, ignore the structural debate between ETFs and mutual funds within your 401k account. Focus instead on passive versus active management. Look for passive index mutual funds with very low expense ratios, ideally below 0.10%. Second, review your asset allocation. As you retire, the goal shifts from aggressive growth to preserving your wealth and generating reliable income. Ensure your 401k mutual funds align with your personal risk tolerance, balancing low-cost equity index funds for long-term inflation protection with high-quality bond index funds for capital preservation and income. Third, check for plan administrative fees. Even low-cost mutual funds can be dragged down by high overall plan record-keeping fees. If your 401k plan charges high overhead costs and you are already separated from your employer, it may be time to evaluate rolling those funds over into an individual retirement account, or IRA, where you get unlimited choice and can select ultra-low-cost ETFs or mutual funds. At the end of the day, both mutual funds and ETFs are merely container structures for holding assets. Inside the tax-protected umbrella of a 401k, a low-cost index mutual fund will perform almost identically to a low-cost index ETF holding the exact same market index. Do not let outdated or irrelevant tax worries cause unnecessary stress. By prioritizing low fees, proper diversification, and automated cash flow management, you can confidently position your retirement savings to serve you well throughout your retirement years.